Good afternoon, everybody. This is Joe Lucey. It's been a while since I've done Market Huddles. I've been relying on Nate and Dylan and a few others to do those. So anyways, glad to be back here. I'm also excited because I have Andy Ives. Many of you have attended when we've had Andy on in the past. Andy is one of our technical experts. He's an IRA specialist, works with the Ed Slott's organization. And I was talking to Andy, I don't know, what a week or so ago, Andy. I'm like, hey, it's been a while since we had you on. What are some things we should be talking about? And you said, boy, there's a lot of things about what didn't happen, a lot of things about some concerns about what might happen. And you thought it would be a good idea to touch on qualified charitable distributions, which I sounded fantastic. So I'm glad to have you on with us again, Andy. So thanks for being here.
Yeah, great to be here. Appreciate it.
So those of you that are clients, that what we'll do here is we'll spend a little bit of time talking about these three areas. If you at the end of the presentation would like to spend some time, whether it's in a phone call, visit with us face to face, that's what we do these for, is to make sure we're giving out some good information. If along the way there's information that we contain here today that you think is something that you would like to share with somebody, Angie on our team is always forwarding on the recordings of these, and then feel free. Let's go ahead and dive on in, Andy. Talking to this week's Market Huddle, QCDs, pitfalls, and basically what are some hot topics we want to be thinking about as we get into 2022 here around our IRAs, and what are some of the areas that the Ed Slott organization is kind of talking about with us, the advisors that are part of the group, and when they're communicating out there in the public. So let's go ahead and jump in. First of all, there's a disclaimer we have to place here. The attorneys have us remind you that anything we talk about that sounds forward-looking may or may not actually happen. Anything that we talk around with investments are not guaranteed. And, I'm not an accountant. In fact, Andy, you're an IRA expert, but you're not a CPA either. But we both spend a lot of time in the world of helping families with their IRAs and such. And so keep in mind, some of the things we talk about, you may want to visit with a CPA or an attorney or something like that. With that said, Andy, I'm going to let you just jump right on here. Let's talk about three things we want to be thinking about here for 2022 to make sure that our retirement is secure and that, nothing's falling through the cracks.
Yeah, for sure. And I have an opportunity to talk with financial advisors across the country. And when you do that, you kind of get to put your finger on the pulse of what's going on. What are the top questions that are coming in? What are the concerns that are coming in? And there were some definite ones that popped to the forefront over the past couple of months in the first part of this year. So when Joe asked if I could join and some things to talk about, these were pretty easy as far as what are the top three things that are he said, hot button issues that are going on. So what didn't happen, that's pretty interesting. Even though it didn't happen, it could happen. And we're going to talk about that here in a minute. QCD pitfalls and warnings. QCDs are such a popular item these days, qualified charitable distributions, but there's ways you can get sideways with them. And I know a lot of people do QCDs at the end of the year. So I know there was a bunch that were just done in the last month or so in December. And I know a lot of QCDs get done early in the year so people can offset RMDs, but you got to make sure you do them in the right way. So I wanted to hit on that as people start to do QCDs and RMDs. And then partial Roth conversions. I know Roth conversions have been a hot topic lately as well. And as people get into 2022, I wanted to get some ideas out there of what to do and some stealth taxes, as we call them, some things to try to avoid, just to be careful with. So anyways, the first slide I have here is what didn't happen. It says the Buildback Better bill, not passed yet, question mark. Last year, probably for the last 3 months of the year, it was nonstop phone calls and emails as far as what's going on with these proposals. What are these tax proposals? What are these IRA proposals? What's going on? What can you tell me about these proposals? I was actually on a radio interview in St. Louis for an hour talking about just the proposals. And I had to keep saying, they're only proposals. They're just proposals. There was people writing articles about the proposals. There was people calling us thinking that they were already passed into law. And we had to walk people off the ledge so many times because there was so much talk about the proposals. Proposals being like You can't convert your after-tax dollars in your IRA to a Roth. You're not going to be allowed to contribute to a Roth IRA if you make too much money. All kinds of things are floating around out there. Higher tax brackets, like a 35% capital gains tax. Anyways, at the end of the day, nothing happened. The Build Back Better bill was not passed. It kind of fell apart there. Now, it still could be re-energized. They might carve it up and come at it with a little more streamlined attack. But as of right now, everything that was in place is still in place. And it's kind of a funny story. We don't write typically anything about proposals because they're just proposals. People ask, have you written anything? No, we're not going to write about it. But we got beat up so bad about these proposals from all different angles that we said, all right, we'll do it. We'll write a little newsletter article in the Ed Slott IRA Advisor newsletter. And we did an article in November about proposals. And it said in big red letters, proposals only. Sure enough, a couple of weeks later, after we published it, the Build Back Better bill gets crushed. And Ed said, that's what I get for going against my mantra. I should have never written this about these proposals. But anyways.
And you know, Andy, we had Ed Slott out just in October, and he was talking a lot about some of the proposals too, which of course, so many of them didn't come through. So you do bring up a good point there about let's make sure we're focusing on what's there and talk high level about proposals, not knowing exactly whether or not they come through.
And I get it. I get why people want to get out in front of things, position themselves for what could come, but never came down the pike. Like, for example, the backdoor Roth. People ask, can I still do a backdoor Roth? And yes, you can. The backdoor Roth is where you contribute non-deductible dollars. You make a non-deductible after-tax contribution to an IRA, and you go ahead and convert it. That's a backdoor Roth. Now, you have to be careful with the pro rata rule. You can't just cherry pick the after-tax dollars. So be careful with that. But it's still available for anybody that does a backdoor Roth. It is still alive, as is that second bullet point. That was a big time topic. Conversions of plan after-tax dollars is still alive. So if you have a 401k, typically you're going to defer money from your salary into the pre-tax portion, the pre-tax bucket of the 401k. You can defer into the Roth bucket of the 401k. And some plans allow an after-tax bucket. It's not Roth, it's just after-tax, like non-deductible dollars that go into a 401k plan. A lot of people have a lot of money in the after-tax bucket of their 401k, and they were frantically trying to get that money put into a Roth IRA before the end of the year. The plan would typically just send two checks. Here's your pre-tax check, and here is your Roth and your after-tax money that would go into a Roth IRA as a tax-free conversion. I get it. If the proposal's passed, then those people would be stuck with this after-tax basis dollars in their 401k or non-deductible dollars in their IRA essentially forever, because it could never be converted. It would just be a nuisance. So I get why people are trying to get ahead of that. Didn't happen. So what's next? The third bullet point. Will it pass and be retroactive? Will it pass meaning the Build Back Better bill? I mentioned that it could be streamlined. They might carve it up and pass some smaller pieces of legislation. I know that there was a big push to for the Congress to pat themselves on the back and say, hey, look what we did to these people that have these $1 million or $1 billion Roth IRAs. We're not allowing them to abuse the system. I wouldn't be surprised if there is still some push to maybe ban after-tax conversions, maybe eliminate the ability to contribute to a Roth if you have $10 million already in a Roth IRA, or if you make too much money. So that certainly could happen. We don't think it would be retroactive to the beginning of this year. So hypothetically, if let's say in April or May they were to pass some legislation that would ban the conversion of after-tax dollars in an IRA or in a plan to a Roth, we think that wouldn't be effective until January of next year, because it would be too hard to unwind any of the conversions that were done already this year. So it could happen. It could be retroactive January 1. We don't think that would be the case. But keep your eyes and ears open. There will still be proposals out there. There will still be thoughts about making changes. But pump the brakes. I guess there's no reason to burn the house down if we don't need to. Just see what happens. And the same thing happened with that last bullet point on there. Rumors about high tax brackets never materialized. I was also getting calls. My taxes are going to be this much. They're going to be this. No, they're not going to be that much. They could be if these proposals were passed. So if we look at the next slide, here's an example of what happened from 21 to 22. So on the left is what the tax brackets were for everybody. And on the right is what they became in 2022. You'll see the numbers are the same, 10%, 12, 22%, the same marginal tax rates on the left. The only thing that changed was a slight increase in the numbers there. So for a person that's married filing joint, if you're in the 22% bracket, it went on the left column, 22%, and went from 81 to 172 to 83 to 178, $178,000. So just nominal increases across the board.
And a lot of that had to do with just the inflation numbers we saw in 2021 and having to carry those over.
Exactly. Yeah. You're just looking at cost of living adjustments, inflation adjustments, just typical slight little increases year over year. So that's a perfect example of what happened. And I know there was panic around, well, long-term capital gains are going to be at 35%. That didn't happen either. The capital gains rates are the same. Joe was talking about how there's nominal tax brackets and there's other like the net Medicare surtax charges. Oh. Yeah, right. But anyways, so nothing changed. Bottom line is no changes to the tax brackets. So that's just something to be aware of. Despite the hive of activity around everything at the end of last year, really nothing happened. So that's what didn't happen. Now let's talk about some more concrete subjects and things to be aware of, things that really impact people on a day-to-day basis as they monitor their accounts. QCDs, Qualified Charitable Distributions, pitfalls and warnings. This is just stuff to be aware of because it could have happened and could happen for people that are donating directly from their IRA to a charity. You can't do a QCD from a plan like a 401k to a charity, but it's just from an IRA. You got to be 70 and a half, and the money typically has to go directly from the IRA to the charity. I say typically because look at that first bullet point. If using a checkbook IRA, make sure the 2021 QCD checks were cashed in 2021. Some IRAs do allow a person to write a check. I mean, you can literally write a check for your groceries if you want to from your IRA. A lot of people do that, and that counts as a valid QCD to write a check to a charity. But here's where they can get in trouble. If you did a check IRA to a charity in, let's say, the last week of December, so just 5 weeks ago, it's often the case where the charity won't even cash it until maybe the first part of January. The custodian doesn't know that you wrote that check. All they see is when it's cashed. So the problem occurs if you write the check thinking you're doing the QCD in the calendar year where you have to do it in the calendar year. You can't do it retroactive. You do it in the calendar year. But the charity doesn't cash it until 2022. That's when the debit happens. And you won't get a 1099 in 2021 because it wasn't debited from the account until 2022. So that's just a warning. If you did happen to write a checkbook IRA QCD, maybe make sure that it was actually cashed last year so that you get the 1099. Do you want to jump in there and say something?
Well, I was just going to say, we have a fair amount of clients that actually do this because while a $1,000 qualified charitable distribution is very easy administratively for us to run through TD Ameritrade or in the accounts we have, when we run into somebody that wants to do maybe smaller increments, they want to gift $100 here and there to a Salvation Army, giving them the checkbook, allowing them to do that, it really frees up a lot of time on our side. But I had never thought of that we have to worry about that check getting cashed before December 31st. And definitely something we're going to be communicating as we get into the end of 2022 to make sure we don't have families doing that. As far as I know, nobody ran that check up to December 31st, but I think that a lot of us think that check could be written last day of the year and still count, but it comes right down to when does the actual money come out of the IRA. So a good point to be keeping in our forefront here.
Yeah, especially for the ones that write the big check at the end of the year. That's the one you don't want to miss. As far as those people that did the QCDs properly and they get the 1099, remember, it's not going to be labeled on the 1099. There's no special code on the 1099 that says it's a QCD. And I understand why. The custodians can't police that. They don't know if it's a valid charity, so they're not going to stamp it as a QCD. They don't know if maybe you did $100,000, you capped out with a QCD from another IRA at another custodian. So they're not just going to, again, stamp it and say, yeah, this one's good as well. So be aware that you have to communicate. And Joe, I think you've said before that you were good about notifying the tax advisors and the clients that they need to tell people so that we're all on the same page that this has to be marked on the tax return as a QCD.
No, and that's a great point too, because everybody that has done a QCD through us here at Secured Retirement should have received a letter from us where we outline the QCDs that we're aware of internally here anyways. And we send those out here. I think they went out, well, they might be going out today, but we were going to try to get them out today so that everybody has it. If you did a QCD through us here at Secured Retirement and you haven't seen that letter in the mail, let us know and we'll make sure we get something together for you so you can bring it to your tax preparer if it's either internally here or somewhere else. So
very smart. Yeah, that's very, very smart, because you'd hate to do the QCD and have it getting missed on the tax return. So that's a good move. The next bullet point, the third one, says do QCDs early. Now we're not worried about last year. Now we're talking about this year, 2022. Do them early, because that first dollar's out rule. If a person is looking to offset a required minimum distribution, they have to do that basically simultaneously with the QCD. QCD goes, and that counts as the RMD. Where people get into trouble is if they take their RMD and then maybe a month later say, you know what, I want to do a QCD with that RMD. You can't go back and offset that RMD that you already took with the QCD. You can do it on the QCD, but it would be in addition on top of the amount you took for the RMD. So just be careful when it comes to trying to time the RMD and the QCD. We say do it early, do the QCD early, so the first dollars out that come out of the IRA is the RMD amount. You can't do a QCD and say, no, that's not my RMD. We'll take my RMD later. None of that works. The first dollars that come out of an IRA every year is the RMD. So either it's offset by QCD or it's not. So do them early if you're going to try to do them.
Now, Andy, I think maybe it's a good point to talk about, the QCD, the Qualified Charitable Distribution, is still available to anybody that is 70 and a half, and that's an actual 70 and a half birthday. You can't do it the same year you're turning 70 and a half, where required distributions have now been pushed off to age 72. So there are families out there that we work with. They can be doing the QCD prior to even having the RMD, so it becomes less important, I guess, when they do that. But those families that are graduating into required minimum distribution world, it really does make a lot of sense to try to make those charitable gifts early on, huh?
Yeah. And that is it is a bit of an anomaly where you can do a QCD at 70 and a half and still have like a year or a year and a half before you get to your RMD. But once you get to the RMD world, you have to make sure you do them simultaneously. And that's what that fourth bullet point talks about. No retroactive QCDs to offset a previous RMD. We certainly heard of people doing that. Trying to take an RMD and then a few months later say, ooh, I want to send that to a charity as a QCD. Can't do it. And the last bullet point is nuts on this thing. I have to say it's crazy. And I think it's goofy how the IRS is worried about this small little amount and people double dipping. Basically, you could have a taxable QCD, and it's strange, but it could happen. If you were to do, let's say, a 73-year-old, because there's no age limits on contributing to an IRA anymore. There used to be before the Secure Act, but now there's not. Technically, a 73-year-old could contribute to an IRA. You can make a non-deductible contribution for whatever. Maybe you make too much money or something, you're still working and you can't deduct it. But that will basically be filed in the minds of the IRS. And let's say that 73-year-old, let's say 7 years later, they do a QCD. That non-deductible contribution will spring forward and offset a portion of that QCD to make it taxable. Basically, the IRS doesn't want you to have the double dip of a non-deductible contribution, or excuse me, a deductible contribution and a QCD. So if you're going to make a contribution to an IRA over 70 and a half, do it to a Roth if you're planning on also doing QCDs. If you make a deductible contribution, you're getting that tax benefit. The IRS does not want you to also have the benefit of a QCD. It just they don't play together well in the sandbox at all. So just keep that in mind, only for those that are of QCD age. So a little bit squirrely there, but I just want to make people aware of that one. Deductible contributions.
And before we move past QCDs, these have been so much more popular here because of the new tax law changes that they're charitable gifts. I know that tax-wise, if you gifted to charities $300 or married couples can write off $600. But anything above that, if you're taking a standard deduction, which is in that, $25,000 to $27,000 range, and I'm able to itemize, these QCDs have really been a great way for us to move money that otherwise would be taxed by you and using the IRA money to do some charitable gifting if you're so inclined. So
Yes.
great tools, but like you're pointing out here, Andy, some little gotchas that may not be necessarily in the forefront of everybody's mind here.
Mm-hmm. Yeah, and you're right as far as the standard deduction. The QCD is on top of that, so you get the standard deduction plus the QCD amount to remove that money from your income. So yeah, QCD is definitely a valuable tool for those that want to give to charity that have an IRA. Okay, and next slide is something about Roth conversions. I know people are trying to get money moved over. They're afraid that tax rates are going to go higher in the next few years, even though we didn't see much change in the last year. So they want to get money moved over. Couple of pointers. Again, we're talking about just pitfalls and things to be aware of. That first bullet point, you cannot convert the RMD. You have to take it first. So as we talked about where you want to do your QCD early in the year so you can offset the RMD, if you're going to do a Roth conversion, you can't convert an RMD. You have to take the RMD first, and then any amount over and above that amount can then be converted. Back in 2020, when RMDs were waived, when we had the whole pandemic issues and the CARES Act, a lot of people were just go ahead and converting whatever they wanted because they didn't have to worry about RMDs. Remember, RMDs cannot be converted. Now they're back in effect. You got to take it first, then you can convert on top of that. Which leads us to bracket bumping, which is a conversion strategy. If a person has $1 million traditional IRA, they might not want to convert the whole thing to a Roth in 1 year because all of that $1 million will be added to their income for the year. One strategy is to, I'm going to go back here a little bit. I'm going to go back to this slide that we talked about here. Let's say a married couple filing joint. I'm looking at the right-hand orange box there, and they're in the 24% bracket. They can go up to $340,000 of income. If you did a gigantic Roth conversion, you could push yourself into a higher tax bracket accidentally. So bracket bumping is a function of, I know what my income is for the year based on my job or what I earned. I can convert X amount of dollars just to take me up so I bump my head on that next tax bracket without going over. So that's the function of, or that's the idea behind the bracket bumping strategy for Roth conversions. You don't have to convert the whole thing. You are allowed to convert a partial amount of your IRA.
Andy, I'm going to stop you for a second because we did have a couple questions from John here. The first one is, actually, I'm going to go to the second one. The second one is, now it's the third. What is a RMD? I can answer that, I suppose, but it's a required minimum distribution. So, John, when you turn 70 and 72, any money that's never been taxed in the IRAs, 401ks, 403bs, and we work with a lot of different families on different what that's going to be and helping them calculate that. But it's going to start off at about 3.65% that has to be withdrawn. If you don't take it, it becomes the largest penalty that's levied by the IRS. So it's a 50% penalty for not taking a required distribution. And we have to take the required minimum distributions, RMDs, from the right account. So we can't commingle. There's a whole lot. Andy, we should probably do another market huddle just on RMDs. But there's a whole lot of things you need to be aware of. If you have 401ks and IRAs, they have to be kind of taken separate. But required minimum distributions, the IRS says they have to come out first once you hit 72, and trying to combine them with things like Roth conversions or you want to make sure that we're doing that the right way. And that's what a lot of families use us for, John, to make sure we're getting those answers. His other question he had here, there's actually a third, about the letter. So when we do, I'm going to bounce around here. I'm going to try to knock these out here. John, you also asked about the letter I'm talking about sending out to us. We send those to families that have done qualified charitable distributions where they use their IRAs to gift to charity. And it's a letter that just kind of summarizes that so you can bring it to your tax preparer, keep it in your files. If you did a qualified charitable distribution, we can make sure you have that. And John, we can make sure our advisor reaches out to you to see if that's something that's available to you and should be done. The last one had to do with IRMAA, income related to Medicare adjustment amount. This right here is it's a sneaky little tax. It's it's what I call it's a phantom tax because we aren't expecting it, and IRS doesn't really call it a tax. But when the IRS looks at our our 1040 tax forms, if our income's too high, our modified adjusted gross income, not to get too deep in the weeds here, is too high, we can end up paying higher Medicare premiums additional premiums than what anybody else is doing because our income's higher than certain thresholds. And it's an area, John, that I think a lot of families, when they visit with us for the first time, may not be aware of until they're in the middle of it. And to me, it's a tax. It's an extra Medicare premium, but if you're paying extra Medicare premiums based on a tax return, I'm going to call it a tax. Anyways, we're kind of up to that. So what are IRMAA surcharges, a stealth tax that I see on your list here, Andy, and maybe we can go from there. And John, not to dismiss your questions too much, but how about if we find some time that one of our retirement specialists can reach out to you, and we'll make sure we thoroughly answer all your questions for you. But go ahead, Andy. I'm sorry for cutting you off there.
No, you're fine. You're fine. Yeah, so I talked about the bracket bumping. I can convert a little bit of my traditional IRA just to take my head up to the next tax bracket. So people think about that, but what they don't think about are these IRMAA surcharges. So if you are subject to these Medicare surcharges, you could accidentally convert too much to push you into a higher bracket here. Now, the scary thing about IRMAA surcharges is this is a cliff. So if you are $1 over into these IRMAA brackets, then you have to pay that surcharge. So if you make a mistake with your incomes, and you earn too much or you convert too much, you could suddenly find yourself paying extra surcharges. So not only do you have to be aware of the tax brackets, but also these IRMAA brackets. And these aren't the exact same. These brackets are not the same. We can click it back and forth. I'm not going to do that, but these brackets are not the same. They don't match exactly with the tax bracket. So you got to keep an eye on a couple of different things there. And this is, and I don't, again, not to get too deep in the weeds. I know Joe said he's going to talk about this, and this is what they call a 2-year look back. So what you earn now will not affect your IRMAA surcharges until 2 years from now. Because if you look at this gray box here, it says combination chart. 2022 IRMAA monthly surcharges for Medicare Part B and Part D based on 2020 modified adjusted gross income. It's a 2-year look back. So it goes back 2 years to see what you earned back then to figure out what your surcharges are for this year. So good time to lean on Joe and his team to make sure you're on the right track with that one. And the last point I made on there, it says dollar cost average into a conversion to smooth market volatility risk. So a lot of people know about dollar cost averaging, where let's say you're going to buy a mutual fund and you might put, I don't know, $200 a month. Every month it buys into this mutual fund. So if the market is up and down, you buy some maybe when it's a little lower, some when it's a little higher, but gradually over time, you will hopefully smooth out the purchasing of that mutual fund. That way you can take out the risk of maybe buying when everything's too high or maybe you're not lucky enough to buy when it's down at the bottom. You can smooth it out. Same thing with a Roth conversion. I think back to when the market crashed real bad back in February, March, when the pandemic hit in 2020. People that did a Roth conversion early in the year converted when the value of their account was so high. And then the market tanked. Had they just waited a month or two, they could have saved all those taxes because the value of the account was so much lower. Same thing with dollar cost averaging. I know some people will do maybe quarterly. If they want to convert, let's say $100,000 in a year, maybe do 4 quarterly conversions of $25,000. So just another idea as far as bracket bumping, as far as dollar cost averaging into a Roth conversion, but also considering the tax brackets and the IRMAA surcharges that are on here.
You know, Andy, before we jump into some other questions here, that's one area that I think our team really adds a lot of value. Families hire us here at Secured Retirement because, number one, they want to make sure they've got an income stream that they can spend in confidence. They want to make sure that they can maintain their lifestyle and not spend money in their 50s and 60s and wish they had it back in their 70s or 80s. Number two is the tax planning we do, which I think gives us an unfair advantage to so many other advisors that really just focus on the wealth accumulation. Wealth accumulation is important, but most of our clients find that looking for an income plan, making sure that they have a way to reduce their footprint, what their obligations are around taxes are so important. Couple questions I wanted to, or that are coming through here, Andy. The first one has to do with the Secure Act 2.0, which of course has some provisions in it about maybe even pushing off RMDs a little longer. Right. Maybe you can talk a little bit about the new RMD tables that are effective here this year as well. So,
yeah, there's a lot of names for that. Secure 2.0, Son of Secure, Baby Secure. There's all kinds of little things in there, and we do anticipate there's going to be some more legislation coming down not only to change some things, but also to clarify some things that were in the Secure Act. So my partner, Sarah, who I work with, wrote an article on our website, IRAhelp.com, and it says, "Are you ready for the son of Secure?" And she just put some bullet points in here. It says other changes include, we talked about what is the RMD. You take the required minimum distribution at age 72. There are proposals in Son of Secure about increasing the required minimum distribution the first year from 72 maybe to 75. I've heard conversations about gradually ticking it up over a number of years, which is going to be a mess because we're going to have all these different ages where people start taking their RMDs. There's talk about increasing the limit on catch-up contributions to 401k plans. And then there's some real nickel and dime things like allowing matching contributions on student loan payments. Joe had mentioned the 50% penalty, draconian penalty on a missed RMD. There's talks about possibly reducing the penalty for failure to take that to 25%. So a lot of little things. But yeah, we do anticipate there's going to be some more changes coming through as far as that Secure 2.0 or Son of Secure.
Another question comes from Mike, and maybe I'll start it and then get your input from it.
Yeah.
Mike is asking us, he says, why would we want to pay taxes on doing a Roth conversion today instead of waiting to take the future required distributions with inflated dollars? And I think it's actually an interesting question because I think where Mike is coming from is, if we had 7% inflation last year, my dollar's worth 7% less. So really the tax I'm paying when I do the conversion is 7% less. And the way I think I would answer this, I'm interested to hear your thought on this too. I'm not, the inflation is one piece, but my biggest fear is that the largest inflation we could very well see could very likely be an increased tax rates. I mean, we put $3.5 trillion out there, depending on how you want to add that up. We're sitting on $30 trillion in national debt right now. I'm more worried about the inflation around taxes than I am necessarily the loss of buying power to waiting. So I think that, Mike, that would be really the question we would be kind of exploring with you is what is a better or a bigger risk to you? The inflation and the dollars being worth a little less or the actual taxes you might pay on inflated dollars? And I suppose it comes down to your own specific situation. Andy, what are your thoughts around that?
Yeah, I agree. People ask all the time, and there is no definitive broad brush answer, yes or no, I should do the conversion or not, based on an person. It all depends on what a person's philosophies are, what their thoughts are as far as what could happen to taxes in the future, and what their goals are. I've had people say, at what age should I stop considering a conversion? And there's no age. A person 100 years old might want to do a Roth conversion because maybe their goal is to leave a tax-free inheritance to their next of kin. That person should consider a Roth conversion. But Joe's right on point as far as the taxes. We anticipate tax rates to go up. They almost have to. This is not to plug it, but this is Ed's most recent book, The Retirement Savings Time Bomb. And there's a page in here, and you can't see it, but this page right here lists the top federal income tax rate by year for the past 100. This goes back to 1913, so over 100 years. So currently we're at 37%, and we've been there for a while. But that is so low. There's numbers on here where the top bracket was even as recent as the 80s, 50%. In 1981, it was 70%. What's crazy, if you go back into the late 50s and 60s, the top tax bracket was 91%. So we have, as Joe said, trillions of dollars of debt that we owe, and we're at an extremely low, historically low tax rate. We've got to pay for this somewhere, so we anticipate that taxes will go up. So the thought process with a conversion is, while tax brackets are low now, do the conversion, bite the bullet, and then your money is now in a Roth IRA. It is growing, hopefully with a good investment and doing well. It will not be taxable when the money comes out. And if the rates go higher, it doesn't matter to you because your distribution is going to be tax-free. If you did nothing now and you left the money in the IRA and what happened, and what happens, the taxes go higher, much higher, even though you're earning money in that traditional IRA, when you take it out, a big chunk of it is going to be gone because the taxes are going to eat into that. So,
Andy, a way I like to talk about this is I think that a lot of times if I ask somebody, what do you have in your retirement accounts? How much are in your IRAs, 401ks, 403bs. A lot of times, most families kind of get us pretty close to that number just off the top of their head. But when I start asking you how much of that's going to be available for you and your family in retirement, understanding that all of these accounts have to be taxed as the money comes out, that number gets a little bit different. So we think of our IRAs and 401k balances as a net worth item on our balance sheets, our net worth statement. The reality is, because none of this money has been taxed, and it all has to be at a future rate, which is somewhat unknown. These numbers are different, and that's one of the things that I want to make sure all of our clients, if you're a client of ours, and we probably should revisit on, and if you're not, let's sit down and let me show you exactly what that number looks like for you. I did want to a couple quick items here. Andy, we did our radio program here over the weekend, and Dylan on our team brought up a really good point. And the question was this: if I asked you, Andy, and you're an expert when it comes to IRAs, how many zeros in $30 trillion in national debt?
Oh man, I have to think about it, but I know it's a lot. Was it 15 or something like that?
Oh yeah, I think that if I ask somebody on the that's listening to us right now, if I said how many zeros in a million, everybody can probably come up with 6.
Right.
We know that there's 9 zeros in a billion. You realize that $30 trillion, that there are actually 13 zeros.
Yeah, it's big.
And planning around taxes is something we absolutely want to do. I'm kind of bringing this a little bit different direction than I think you and I discussed before the program here, before today's Market Huddle. But I have a few extra copies of Ed Slott's book. They've been signed by Ed. So if somebody is a client of ours and you have not received that book, I'll make sure I get you out a copy. If you are not a client of ours and you want to revisit, let's schedule and do kind of a tax analysis. Let me show you what these 13 zeros and 30 trillion might mean for you in future taxation. I'll make sure you have an Ed Slott book when you're walking out the door. And if you have somebody that you think would benefit from the planning we do, if you're already a client of ours and want to refer them on to us, we'll make sure when they come in that they get a copy. And again, if you're a client, I'm happy to make sure you have a copy.
And easy reading. I'm proud to say my name is in there. In the thank you part, we did a lot of help with that book. It's a great book. Good for anybody to listen to.
And I'm going bouncing between. I guess that now we have two different. We got a chat and a Q&A. It's a new software feature here. But John, I'm going to make sure somebody reaches out to you after the presentation here today or the discussion. Mike, Kurt, you have any questions? Let's make sure that we can come back and review those. Let me talk a little bit about next week's Market Huddle. What we're going to do is, especially this time of year, so many families are looking to pull down their tax documents so they can get their tax prepared. We want to make sure that we can see what our returns are. We had a little bit of market volatility, more so, who knows? I think we're going to see some going over the next few weeks as they're making adjustments, trying to address this inflation issue, maybe raising interest rates. But families want to make sure that they know what their returns are. How do we do those? So Bradford on our team here is going to be hosting next week's Market Huddle. He's going to make sure he walks through with everybody what are the 2 websites, maybe 3 websites. How do we make sure that you have access to your information as a fiduciary? That you can get those to the rightful people. If you have not, are not real comfortable accessing your statements through TD Ameritrade or Fidelity, or if you haven't been on Orion, which is our performance monitoring software, I encourage you to join us next week. Or maybe if you aren't a client and want to kind of see what some of the technology we want to make sure everybody has, that'd be a good one. And who knows, Bradford probably has a few tips and tricks that I'm not even aware of on some things you want to be able to know when you're pulling down your reporting. So next week's going to be a great Market Huddle, especially for those of you that have accounts with us. I encourage you to join us then. We'll be sending off something. Also, everybody should get a replay of today's presentation. We went a little longer than I like to go, but I think we had a lot of great information going back and forth. Andy, and I really appreciate you being on here for us. I'll send you off a recording of this. If you'd like to review it, that'd be great. If you know somebody you think would benefit from it, somebody that's doing some charitable gifting that may not be able to take advantage of because of deductions, or somebody that has required distributions, may not be familiar how those come into play here, this would be a great presentation to send on to us. And of course, you can make sure that you're always being notified of future presentations by signing up for our newsletters and what have you. You know, Angie likes me to remind everybody, go to our Facebook page. It's pretty easy to find. Just go to Facebook and search for Secured Retirements. I'm on LinkedIn personally. We also have a business page, YouTube. We'll make sure if you have any questions on how to access any of the Instagram and Twitter accounts, just why don't you send info@securedretirements.com an email, and we will make sure that we get you the access or the links that you need there. Our phone number, we're here if you need us, 952-460-3260. If you had questions you didn't get a chance to answer, or if you, Mike, you know, like your question's a little bit more situational, let's spend a few minutes on time and make sure that that you walk away with a good answer that you feel comfortable with. I know that John had some questions too. So John, I'll make sure somebody reaches out to you. You know, as we wrap up here, Andy, any parting words before we let everybody go here for the week?
No, I just say, you know, lean on Joe and his team. We talk to so many advisors, and we hear so many horror stories of people trying to do things on their own, and they just get in trouble with stuff. So whether it's a QCD or required minimum distribution, I just say, ask a question. Ask Joe the question, lean on his team, and he'll point you in the right direction.
Hey, you know, the great thing is, Andy, when I don't know the answers, I get to call you, and you make me look like I know the answer the whole time. Right. And the relationship we have with you and Ed Slott's organization is invaluable. So I thank you again for taking some time to join us here today. It's been way too long. I think that having a session like this just on required distributions, I think that would be really entertaining or really informational for the family. Yeah. So let's try to figure out a time we can do that sometime in the next few weeks. I know you got some things going on. I was talking to Andy before the presentation. I said, so what's it like there in Jacksonville, Florida? And he was complaining because it was 22 degrees. I looked at our weather app. It's 22 here. I said, boy, it sounds like we're kind of in the same boat. And he goes, yeah, but you don't have iguanas falling out of trees like we do down in at least southern Florida. So anyways, Andy, stay warm up there or down there in Jacksonville, and
I'll do my best.
We'll send you warm thoughts from Minnesota here. All right, guys, that's all we have time for this week. We'll be back, and feel free to reach out to us. Info@Secured Retirements. Give us a call. Reach out to your retirement specialist direct, whatever works for you. Thanks again, Andy. Have a great week.
You're welcome. Thanks, guys.
Bye-bye.